So I have this gentleman who is telling me they were trading last night, uh, July 1st, 9:30 p.m., and they were trading 10 on S, and they were trading fall, and they experienced losses. So I asked him, let me see what exactly you did. So I have come to the market to look at exactly what happened. So you can see this is what I normally do when I look at any market. I come to a market like 10 on S, for example. I have to identify a certain trend in the market. Is it rising or falling in a longer time frame? Then I'll break it down to maybe 1 minute time frames or 5 minute time frames. So when I come to the 5 minute time frame or the 1 minute time frame, I am able to see, is this market really on a downtrend or not? As you can see, that market is clearly on a downtrend. Yeah. Now, the time they executed the trade is what's most important, because the market can be on a downtrend, but there will be pullback zones whereby you will not be able to trade. Now, in layman's language, if you're trading any market on a DERIV and you're trading in the rise and fall category, understand one thing. These markets are either going up, going down, or they are consolidating. Ziko hapo katikati, you can't tell where they are going. So your job is to catch them in a specific trend. I focus on trends only. And in these trends, there are places in the market where they are called the trends, and then there's the reversal parts. So you need to catch the market when it's trending in a specific direction and don't trade against the market. So this was his entry point, as you can see right here. This candle right here, this was his entry point. Now, with the strategy I use, I do not trade with ticks. So if I'm not trading with ticks, it means it doesn't matter what the ticks are doing. It doesn't matter what the candle is doing in terms of retesting. What matters is the trend of the particular market. And rise and fall is the easiest market. Now, if this is the time he made an entry, of course, he was going to experience losses. Now, number two, at this particular point, if you're going to use indicators to guide you, you can already see this market is nearing the oversold region. Actually, it's in the oversold region in the RSI. So here, trading fall, you're obviously going to make losses because the market is already in the oversold region. Meaning, anytime the market is in the oversold region, it has to climb back up to the overbought region right here. And it can take a few minutes, it can take a very long time, depending on how the market behaves at that time. So if you're going to use indicators, if you're going to trade rise, number one, make sure the market is in the overbought region, somewhere up here or somewhere close to up here. Then calm down with it. Of course, the market has to be on a specific trend. This is just people who trade with indicators purely. Okay. Number two, look at the types of indicators you're using. Of course, people use various indicators. I use moving average and RSI only, and they work very well for me. If you look at my channel, you'll see all the signals I send. They're based off of these two indicators alone, amongst other things. You get my point? So if this is how you're going to be trading, make sure you look at what the indicators are telling you. If you're going to trade fall, make sure the market is truly on a downward trend. Don't enter in a place where the market is facing like a small pullback or like a small reversal, because right here you're going to lose money unless you're trading manually, whereby this will be your entry point. For example, if you're trading manually, this will be your entry point right here, right here. And as you can see on the far right, the price is 89.57.9. You're trading manually and you trade for 5 minutes. This is what happens. The first candle is 1 minute, 2 minutes, 3, 4, 5. This candle, yes, is red, but it's still above your entry point. So let's assume you traded for 6 minutes. This will have been your exit point right here in this particular candle, and your exit point will be down here. And in a fall market, your exit point has to be lower than your entry point. As you can see right here, it's 89.54. Here it was 89.57. If you're trading rise, it's the complete opposite. So this was not a perfect entry. The place where you would have made an entry would have been somewhere like here. But then again, you need to look at multiple things before you just jump into the market. And I'll tell you just one thing which is very easy that many people know. You can see the market will give you something called an engulfing pattern. So there's a bullish and a bearish one. This is a bullish engulfing pattern, as you can see right here, whereby a green candle forms, and it's after a series of green candles, then a red candle shows up, and the red candle is bigger than the body of the green candle, the last green candle. Okay, that would have been a perfect place for you to make your entry, but you entered the market at the wrong time, and because of that, you experience losses. So if you're going to be trading rise and fall, understand one thing first. Look for a market that's trading in a specific direction. Number two, trade alongside the trend. Don't go against the trend. Ni kama tuko kwa mto, you're swimming in a river. If you're trading against the tide of the river, you're going to have a hard time swimming. You swim alongside the tide of the river, or the direction the river is flowing, not against it. Number three, look at the indicators you're using. If you're using indicators to do your analysis, here on DERIV, you can actually trade with indicators purely without doing many other things. Okay. Once you figure those things out, that is the time you'll be able to execute your trades and trade with something called risk management. Don't just put a big stake or use a big lot size, especially in specific markets, and expect to just miraculously make money. No, there's a sequence as to how you will have done these things. This will have been your entry point right here, but you entered at this particular point. This is not a good entry point. Hapa kupoteza pesa ni one time. Nimesema one time, not one time. So here making money is very, very hard, but here it will have been easy because there's an actual direction. Now, would you have known this will have happened? Yes and no. Yes, because you're doing market analysis, and it's the market usually repeats itself from time to time. You'll see specific patterns appearing multiple times after something has happened. So you would have easily known if this was going to be a good entry point or not. And also the answer is no, because again, even if you have the best strategy, sometimes the market just goes the complete opposite direction of your strategy. So the best bet to do is have your information correct about the market analysis and your entries, so that when you enter, you know very well you checked everything and everything checked out before you made your entries. Ndo hata market ikikugeuka, shida si wewe, shida ni market ili decide kwenda a different direction, and that happens from time to time. You get my point? So yeah.